Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Most people don't lose money because they're broke, they lose because they lack financial IQ. In this video, discover how the liquidity trap silently destroys portfolios and why smart investors think differently during economic uncertainty. Your portfolio growth starts with how you think, not how much you earn.
So what if the very thing you were taught keeps you safe? Saving a portion of your paycheck, keeping debt low, and just putting your blind faith in a 401k. What if that is basically mathematically guaranteed to make you poor?
Yeah, it's a terrifying thought.
It really is. You look at that magic number, right? The one the financial experts told you to aim for by age 65. And then you watch like a really rocky week in the markets and you suddenly wonder if playing it safe is actually just financial suicide.
Right. It touches on one of the most deep-seated financial anxieties we have.
Yeah.
We rely on all these long-term projections and models, just kind of assuming the system will work the way our parents told us it would.
Exactly.
But under the surface, I think for a lot of people, it often feels incredibly precarious.
It totally does. So today we're taking a deep dive into some source material that grabs that exact fear and just, well, rips it wide open.
Yeah, they do not hold back.
No, they don't. We're looking at a text from a financial community platform called Asset Empire. Now, full disclosure, right up front, the rhetoric in this excerpt is it's aggressive.
Very aggressive.
They talk about unlearning the lies of fake teachers, they call out traditional banking systems, and they really do not mince words. So our mission today isn't to endorse their viewpoints or take sides on any of their claims. We are simply here to impartially unpack the mechanics of their strategy.
Right.
It's all about retirement planning at any age, so you can understand the architecture of this highly provocative perspective.
And that's a really crucial distinction for us to make. We are just examining the machinery of their argument because they are fundamentally challenging the standard financial advice most of us grew up with. They're basically arguing that the traditional playbook is entirely obsolete.
Okay, let's unpack this. Because the contrast between traditional advice and this source's core thesis is jarring, to say the least.
Oh, absolutely.
I mean, most of us are taught that playing it safe in the information age is the only rational move. But Asset Empire claims that playing it safe is precisely what makes someone, in their words, stupid.
Yeah, they completely flip that script. They argue that the fear of outliving your money exists specifically because of how the traditional school system has trained us.
Right.
They claim we've been conditioned to act as what they vividly describe as a church mouse.
A church mouse, that paints quite the picture.
It really does, right?
Yeah.
In their definition, a church mouse is someone who works incredibly hard for 40 years, scrimps, saves every leftover penny, and ultimately just crosses their fingers.
Just hoping it works out.
Exactly. Hoping that the government or Wall Street will be there to take care of them at the end. And they contrast this passive existence with a group they call the future elite.
Okay.
For this group, the source argues that retirement isn't an age you reach. It's not even a specific savings account balance.
Wait, so what is it then? If it's not an age or a multi-million-dollar number sitting in a Vanguard account?
They define retirement strictly as a financial state. It's the exact moment where your assets provide enough ongoing cash flow to completely cover your lifestyle.
Wow.
So the goal isn't hoarding a giant lump sum that you slowly drain until you die. The goal is that you never actually need a paycheck again.
Right.
And to get there, the source says you have to move your thought engine out of the income column and into what they call the investor quadrant or the I quadrant.
You know, that shift from the earned income column to the investor quadrant, it really makes me think of transportation.
Oh, how so?
Well, relying on earned income, your paycheck, it feels like running on a treadmill. You have to keep sweating, keep moving your legs, and the second you get tired or, heaven forbid, sick, the whole thing just stops.
Yeah, that's a really good point.
But acquiring assets, that's like building a self-driving car. You put in all the hard work of building the machine up front, but once the engine is actually running, it moves you forward whether you're actively pedaling or not.
The treadmill versus the machine. Yeah, that is a great way to visualize their view on cash flow versus earned income. The source insists that relying on the treadmill is literally the most dangerous place you can be.
But I have to push back here a little bit because the source says focusing on earned income is the single biggest mistake people make, primarily because it's taxed at the highest possible rates. They cite, what, anywhere from 40% to 60%, depending on your bracket in your state.
Right, the taxes are brutal.
But how do people survive if they don't focus on earned income? I mean, almost everyone listening to this relies on a paycheck to buy groceries, pay rent, and, just keep the lights on today.
What's fascinating here is how the source separates surviving in the short term from wealth building in the long term. They use a concept they call the language of money.
Okay.
They aren't suggesting you just quit your job tomorrow and stop buying groceries,
Well, that's good.
right? They're pointing out a structural difference. The rich do not work for money. They work to acquire assets.
Assets being tangible things, right? Like real estate, businesses, or commodities like gold and silver.
Precisely. The language of money dictates that if you are trading your time for a paycheck, you are in the most heavily taxed, highly vulnerable position possible. You're generating ordinary income.
Right.
But if you acquire assets that put money into your pocket every single month, regardless of your physical labor, you're creating what they call infinite returns.
Wait, infinite returns, that sounds, I don't know, like a marketing buzzword. How does a return actually become mathematically infinite?
I know, it sounds like complete hyperbole, but there's a specific mechanical definition for it in real estate investing.
Okay, walk me through it.
An infinite return happens when you have absolutely none of your own initial capital left in a deal, but the asset continues to pay you cash flow.
But how do you get your money out of a house without selling the house?
Usually through something like a cash-out refinance.
Oh.
So you buy a distressed property, you fix it up to force its value higher, and then you go to a bank. The bank appraises it at the new higher value and gives you a new loan based on that higher number.
Right.
You use the proceeds of that new loan to pay yourself back your original down payment and all your renovation costs.
Wow. Okay.
Now, your personal money is completely back in your pocket. You can go buy another asset, but you still own the first property, and the tenant's rent is paying the new mortgage.
That's crazy.
Since you have $0 of your own wealth trapped in the deal, any cash flow you make is an infinite return on your capital. That is what they call the escape velocity from the church mousetrap.
Okay, so if you're young and you have like zero capital to begin with, how exactly are you supposed to pull off a cash out refinance? How do you even start acquiring these assets?
There's a question.
Because the source breaks this down chronologically. So let's look at their playbook for the young first. They say that if you're young, time is your greatest asset. We hear that all the time, right? With compound interest.
Right, constantly.
But the text flips it. They say time can actually be your greatest liability.
Yeah, the source argues time becomes a liability if you spend it as a spectator.
A spectator.
Yeah, a spectator is someone who just watches the economy happen to them. They're scrolling through social media. Or worse, they get distracted by what the text calls shiny objects.
Shiny objects. Yeah, they specifically mention chasing the latest crypto craze or buying a fancy car that just bleeds money out of your pocket every month in depreciation and insurance.
Exactly. So instead of consuming, the text insists young people need to invest their time primarily in their financial education. And to prove you don't need a massive bankroll to start, they use this very specific anecdote involving the personal finance author Robert Kiyosaki.
Yes, the Maui condo. So if young people aren't supposed to chase crypto, how do they actually get in the game? The source uses this story where Kiyosaki started by buying this small $18,000 like janky condo in Maui.
And they highlight that this particular real estate deal put a grand total of $25 a month in his pocket after all the expenses were paid.
Here's where it gets really interesting, because I look at that and immediately question the math. Why would a financial text celebrate $25 a month?
Right, it doesn't sound like much.
You certainly cannot retire on that. I mean, it barely covers a couple of streaming subscriptions. It seems like a colossal waste of effort for $25.
It absolutely sounds absurd when you look at it purely as an income stream.
Hmm.
But the source insists you have to view it as an educational mechanism.
You know, it reminds me of a pilot's flight simulator.
Oh, I like that.
Yeah, when you're learning to fly, they don't just toss you the keys to a 747, which in this case would be like a massive multi-million-dollar apartment complex.
Exactly.
You log hours in a low-stakes environment. You practice the takeoffs, the landings, the emergency protocols. The $25 a month is just proof that the simulator is working and you haven't crashed the plane.
That simulator analogy hits the nail right on the head. The source emphasizes that the tiny cash flow from that condo trained his brain.
Right.
It wasn't about the $25. It was about the neural pathways he built by executing the deal. Just think about the mechanics involved in that tiny transaction.
Yeah, he had to find it first.
Right. He had to learn how to identify an undervalued asset. He had to figure out how to secure the financing, negotiate the closing, place a tenant, and manage the expenses to ensure a positive cash flow.
That's a lot of steps.
It is. And once you unlock that formula, you are no longer a spectator. You have trained your brain to spot opportunities and navigate the actual friction of a real-world deal.
So you basically learn the language of money by speaking it, even if you're just kind of babbling at first.
Exactly.
But understanding the mechanics of a $25 deal is great when you have 4 decades for those neural pathways to pay off. What happens when the clock is really ticking?
Right, the older demographic.
Yeah, if someone realizes at 50 or 55 that they are stuck in the church mousetrap, they don't have time for a pilot simulator. So let's look at how the source addresses people who are middle-aged or older. People who might be feeling a very real panic that they started too late.
So for this older demographic, the source argues that the fundamental rule of acquiring assets remains the exact same. But the mindset shift has to be much, much more aggressive.
Okay.
It starts with your internal vocabulary. They say you have to completely banish the phrase, "I can't afford it," from your mind.
Because saying I can't afford it just shuts the brain down. It's a period at the end of a sentence.
Exactly. The source actually notes that "I can't afford it" is a symptom of laziness.
Wow.
Yeah. Instead, you have to ask, "How can I afford it?" That turns a statement into a question, which forces your brain to start looking for creative solutions and untapped resources. And the very first place you have to look, according to the text, is your own financial statement. They call this your real-world report card.
And reading that report card requires facing some incredibly hard truths. The text introduces a phrase that is honestly pretty brutal. They call it two-legged liabilities.
It is a harsh term, but they use it deliberately to shock the reader. The source defines two-legged liabilities as people in your life who are actively draining your wealth.
Right.
This could be family members who are financially unprepared and entirely reliant on you, or it could be bad financial advisors who are charging you hefty fees while your portfolio basically stagnates.
Okay.
The argument is that at a later stage in life, you simply do not have the runway to carry these liabilities if you want to build an asset empire.
So you clean up your report card, you ditch the bad advisors, you set boundaries with family. But how do you actually acquire the assets if you're starting late and you don't have a giant pile of cash?
Right.
This is where the source takes a highly controversial stance. They declare, in no uncertain terms, that savers are losers.
Oh yeah, that phrase usually makes traditional financial planners cringe.
I bet.
But the source argues that in an inflationary world, the purchasing power of cash sitting safely in a bank account is just constantly shrinking. That is the core of their argument against traditional saving.
And their alternative to saving is where I think a lot of people listening might feel their blood pressure spike.
Definitely.
The source says that at this middle-aged stage, you must use good debt and other people's money OPM to acquire assets.
OPM is basically the fuel for this entire strategy. In practice, other people's money usually means leveraging bank mortgages, partnering with private lenders, or utilizing syndications where you pool funds with other investors to buy much larger properties.
Okay, but I have to stop here. Because for most of us, debt is a terrifying word. Taking on massive leverage to build an empire, especially in your 50s or 60s, sounds incredibly risky.
Sure, it sounds counterintuitive.
Like, if you load up on debt to buy an apartment building and the market tanks or a bunch of tenants suddenly leave and stop paying rent, isn't that just a direct path to bankruptcy? How does the source justify taking on that level of risk so close to traditional retirement age?
If we connect this to the bigger picture, the source provides a very specific macroeconomic justification for why they believe holding debt is actually safer than holding cash. Yes. They point to the mechanics of fiat currency and inflation. They argue that the government is constantly printing what they refer to as fake money. And the specific statistic that tech cites is that $1 trillion is being printed every 90 days.
So the sheer volume of currency entering the system basically dilutes the value of every single dollar you have saved in your bank account.
Exactly. Let's look at the math behind their argument. In their view, because the currency is continually devalued by all this printing, debt is actually the new money.
The new money.
Right. Imagine you use OPM to borrow $500,000 today at a fixed interest rate to buy an apartment building. Over the next 10 years, the government prints trillions more dollars, which causes inflation. The cost of living goes up, which means the rent you charge your tenants goes up, and the nominal value of your building goes up.
Yeah.
Maybe goes up to $800,000.
But your debt didn't go up.
Exactly the opposite.
Yeah.
Your debt remained fixed at $500,000. And you're paying back that original loan using tomorrow's cheaper, devalued dollars that you collected from higher rents.
Oh, wow.
So to the future elite, the source talks about, holding cash is a guaranteed mathematical loss because of inflation. But holding fixed-rate debt that is backed by a cash-flowing asset is the ultimate inflation hedge. The debt gets inflated away while the asset value climbs.
Which brings us to the ultimate showdown presented in the source material, testing this philosophy of debt and real estate against the holy grail of traditional retirement, the 401k.
Right.
This is where they apply everything we've talked about, and they actually label the 401k a fake asset.
They do. And their reasoning hinges on two mechanical arguments. First, they argue that with a 401k, the individual has absolute zero control.
Not at all.
You hand your money over to mutual fund managers, and you just sit back and hope the market goes up. You are entirely passive. You can't pull levers to improve the performance of an index fund the way you can renovate a rental property or raise rents to force appreciation.
Right. And the second argument is the tax trap.
The heavy hit comes when you actually try to use the money. When you withdraw funds from a traditional 401k in retirement, it is taxed as ordinary income.
Which is brutal.
You are forced to pay those high tax rates we talked about earlier, right at the most vulnerable moment when you stop working and need the money the most.
Whereas with real estate, the future elite are playing a completely different game with the tax code. The source specifically highlights the power of a mechanism called depreciation.
Depreciation is the absolute game changer in this philosophy. It's how real estate investors legally shield their income.
How does that work?
Well, the IRS acknowledges that physical buildings suffer from wear and tear over time. Like roofs eventually need replacing, foundations settle, appliances break.
Sure.
So the tax code allows real estate owners to deduct a portion of the property's value from their taxes every single year as a business expense.
Wait, let's break down the mechanics of that. The property isn't actually losing value in the real world, right? Because usually, real estate appreciates over time.
Right. That's the magic of paper losses.
Yeah.
Let's say you buy a property and the building itself is valued at $275,000.
Okay.
The IRS says residential property depreciates over 27.5 years. That means you get to deduct $10,000 a year from your taxable income as an expense.
Just automatically.
Automatically. Now imagine that property generates $8,000 a year in actual positive cash flow that goes directly into your bank account.
So you made $8,000 in real money.
But when tax time comes, you subtract that $10,000 depreciation allowance from your $8,000 profit. So on paper, to the IRS, your business actually lost $2,000.
So you have $8,000 of real cash in your pocket. But legally, you show a loss and pay 0% in taxes on that income.
Exactly.
It's a phantom loss that shields your real money.
It is entirely legal, and it's encouraged by the tax code. But the source also makes it very clear that you cannot pull this off alone.
Oh, definitely not.
They emphasize that you cannot scale this kind of retirement plan as a solopreneur. As soon as you start building an empire and utilizing these complex tax strategies, you become a target.
Right. They warn against what they call the litigation lottery. As you acquire more assets, people might try to sue you to get a piece of your wealth. That is why they insist you must hire a team of experts.
Absolutely essential.
Specifically CPAs to handle the complex mechanics of depreciation, and attorneys to structure your assets in trusts or LLCs so they are walled off and protected from lawsuits.
Yeah, you have to build a fortress.
So what does this all mean? If we synthesize this entire debate, the source basically views the traditional 401k as a passive black box. You throw your hard-earned money in, you cross your fingers that the market doesn't crash, and then you get hit with ordinary income taxes on the way out.
Right.
Real estate, on the other hand, is an active business. You use other people's money to buy it. You use inflation to shrink your debt. You use depreciation to legally shield your income from taxes, and you build a legal fortress around it with a team of professionals.
This raises an important question for anyone listening, though, because it highlights the massive trade-off.
What's the trade-off?
The strategy outlined in Asset Empire demands intense, continuous active management. You have to educate yourself constantly. You're hunting for undervalued deals, managing properties, overseeing renovations, and coordinating with lawyers and accountants.
It sounds exhausting.
It is running a business.
Yeah.
That is vastly different from the set-it-and-forget-it nature of traditional retirement planning, where a portion of your paycheck just automatically vanishes into a target date fund and you go about your life.
It requires a completely different lifestyle and a much higher tolerance for friction. Which brings us to the core takeaway from this deep dive. Whether you agree with the aggressive asset empire philosophy, or you find the idea of leveraging debt and dealing with tenants way too risky for your blood, the underlying message is about making a fundamental shift in how you view your resources.
Yes.
It's about moving from being a passive spectator who just accepts whatever the market decides to do to your savings to becoming an active producer in your financial life.
It's really about taking total ownership of the outcome, understanding the mechanics of the system you're in, regardless of which vehicle you ultimately choose.
And the source really wants to drive that commitment home. They actually end their text with a very specific call to action.
Oh, right, the comment section.
Yeah, they ask their community members to leave a public comment saying, "I will be rich," as a form of accountability to their future legacy. They also offer a tailored report comparing the exact mathematical tax implications of a 401k versus a real estate portfolio to prove the numbers on what we've been discussing today. It's all geared toward forcing you to make a conscious choice rather than just floating along on the treadmill.
It certainly forces you to examine the assumptions you've held about money your entire life. And I'd like to leave you with one final thought to mull over, building directly on the source's concepts of reclaiming your freedom and mindfulness.
Okay.
The entire text frames this aggressive strategy around the pursuit of infinite returns so that you never ever need a paycheck again.
The ultimate financial escape hatch from the church mousetrap.
Exactly. But imagine if you actually achieved that tomorrow. If your assets completely covered your lifestyle, your debt was managed, and your time was suddenly entirely your own.
That sounds like the dream.
No commute, no boss, no 40-hour work week dictating your schedule. What would you actually do with that freedom? Because mastering the language of money to escape the trap is really only half the equation. Figuring out the language of your life once you finally get that time back, well, that might be the real deep dive.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.